We believe the market just reached a local top. We sold our Microsoft bought at 386 in March and trimmed half our Celestica at 163 after a 68% run in just a few months. Today, asset managers are all in. The NIM Exposure Index just hit 99%. That means institutional portfolios are fully invested with no cash left on the sidelines. Why does this matter? Because it means the market already received the flows of the assets managers. That doesn't have more room to invest. It means the flows of asset managers won't support more the market on the short term. Without active asset managers, a major pillar of demand just stepped aside. That's why risk increases, not because of fear, but because one of the market's largest buyer groups is already fully deployed. And here's the problem. When asset managers are 100% in, they have only two options left. Option 1, take on leverage. But they rarely do, and as you can see, when they do, it's modest. We almost never go meaningfully above 100. Maybe 102, maybe 103, but it almost never goes beyond that. Except for a spike to 120 back in 2017, a clear outlier. Today, we're at 99. Whether it ticks 1 point higher or not doesn't matter. We're already at the ceiling. Option 2, start taking profits, which means they're no longer net buyers. They're potential sellers. So not only is this cohort unable to support further upside, it may soon become a source of pressure on the way down. History confirms it. Every time this cohort goes all in, the market struggles to go any further. Let's take a look at the recent occurrences. The last time we reached such an extreme, the NIM index hit 99.24 on December 11th, 2024. It marked a local top on the S&P 500. Then came July 3rd, 2024, a peak at 103.66, followed by a brutal 16.9% drawdown. These signals have proven remarkably accurate. Just a few months earlier, March 27, 2024, the index hit 103.88, and the S&P dropped 8%. Almost every time it signals a local top. By late December 2023, we saw a reading of 102.71 that led to a 5% correction. Same thing in late July 2023. With a reading of 101.82, the market dropped 11%. And of course, back in late November 2021, the NIM index spiked to 103.14, right before the massive 39% bear market. Each time, the same pattern. When positioning becomes too optimistic, the market runs out of fuel, and the sell-off begins. And that's not just coincidence. There's a clear logic behind it. When asset managers are all in, they can't buy more, but they can sell, and that shift in balance, from demand to potential supply, is exactly what tilts the market. We've just crossed 99. That's not optimism. That's overexposure. And when positioning gets this stretched, markets don't climb, they crack. Now let's be clear. At Glacium Research, we remain bullish on equities. This isn't a call for a bear market. It's a call for a reset, a short-term correction, a necessary pause, after months of relentless inflows and stretched positioning. We're talking about a pullback, somewhere between 3% and 10%, before the next leg higher can resume. And historically, that's exactly what tends to happen after powerful rallies like the one we've just had. Let's now look at the data and what history tells us after such aggressive winning streaks. If we take a look at other V-shaped recoveries, just like the one we are living right now, triggered by Trump's tariffs, we see the same sequence unfolding again and again. Take early 2020, a massive rally fueled by an explosion in M2 liquidity, and as soon as the market broke to new all-time highs, realizing a V-shape, a quick 10% correction followed. Same thing in early 2019. Strong V-shaped recovery, new highs printed, and then immediately an 8% pullback. It's not just about these two cases. Even in early 2012, after the sovereign debt crisis in Europe and the US downgrade, markets dropped more than 20%, then recovered just as quickly in a sharp V-shape, and once again, as soon as all-time highs were taken out. A correction followed, 11.4% this time, every single time. It's systematic. That's what makes it so important, especially when we combine it with today's positioning, with funds going all in on equities. The probabilities of a correction aren't just high, they're overwhelming. But that's not all. Over the past 60 trading sessions, the S&P 500 has delivered a massive 25% gain. How rare is that? Since 1970, it's happened only 8 times, as you can see on screen right now. But here's what really matters. Every single time, a correction followed. Let's start with the most recent case, June 8th, 2020. The S&P 500 hit that 25% threshold in 60 trading sessions. What happened right after? An 8% pullback, almost immediately. Same setup in 2009, another 25% rally in just 60 sessions. Then came another 8% correction, or take the one before, early June 2003, right after the dot-com crash. Signal triggered again, followed by a healthy 5.5% pullback. So when we say these vertical rallies tend to pause, it's not just a hunch, it's what the data keeps showing. Right now, the put-to-call ratio is also definitely worth watching because it allows us to measure how aggressive investors really are. When this ratio is low, it means everyone's loading up on calls, betting on upside, and that's exactly what's happening today. We're sitting down around 0.8. As you can see on the chart, every time this ratio hit similar lows, it coincided with local tops in the market, over and over again. It's one of those simple yet powerful signals, not perfect on its own, but when combined with positioning data and historical patterns, it confirms the odds of a pause or a short-term pullback are now significantly higher.